Welcome to the chart lecture. Today, with this SPY monthly chart as our backdrop, we're learning about financial crises. If you invest, there are three major collapses you need to know. Black Monday in 1987, the global financial crisis in 2008, and the pandemic shock in 2020. Why does it matter? Historically, every bubble shows the same signals. Chart patterns and crowd psychology both repeat. The goal today is to recognize a crisis before you're in the middle of one, and to be ready when you meet it. Drop a comment with your feedback. We'll learn together so we don't repeat the same mistakes. Every sharp drop you see on this SPY weekly chart follows a shared pattern. Finance recognizes a five-stage bubble structure. Not every bubble hits the cycle exactly, but if you grasp the common mechanism, you can prepare for the next crisis. Stage 1 is displacement. A new technology, policy, or deregulation appears. Think the 1990s internet boom, early 2000s easy Fed money, or the crypto deregulation wave of the 2010s. Stage 2 is boom. Investors rush in. Banks open the credit spigot, borrowing gets easy for almost anyone, and prices start climbing fast. Stage 3 is euphoria, the most dangerous stretch. People only think it'll keep going up. Like when coffee goes from $3 to $4.50 and nobody even flinches. The myth of this time is different spreads everywhere. Stage 4 is distress. Warning lights flip on. Tighter regulation headlines, a major firm's fraud or failure exposed, talk of Fed rate hikes. Those kinds of signals show up. Stage 5 is revulsion, a panic-selling spiral. Once some sell, prices fall, then more sell. Forced liquidations pile on until a bottom finally forms. This stretch is the main crash phase. On this SPY weekly chart, find October 1987. That week the S&P 500 fell about 22% here in a single day, still the worst one-day drop on record. The trigger was automated selling. Conditional orders like, if stocks drop 5%, sell everything, cascaded like dominoes. One algorithm starts selling, price falls. Another algorithm auto-sells, price falls again, more selling. Machine rules spread like emotion, a mechanical panic loop. But here's the key, the real economy didn't break that day. Corporate earnings and economic data hadn't suddenly collapsed. Recovery began the next day, and within about a year and a half the market had fully healed. The pattern history keeps repeating. The first day of a crash is often mechanical panic, not a deep economic problem. Hold that thought. Comparing it with 2008 makes the difference much clearer. 2008 was nothing like 1987. On the SPY weekly chart, the market fell about 57% over 2 years. Not a mechanical drop, but a system-wide collapse. The cause was a housing credit bubble. From 2001, cheap Fed money poured into real estate, and even borrowers with weak credit could get mortgages. Picture someone earning $40,000 a year getting approved for a $400,000 home loan. Banks packaged those risky loans into mortgage-backed securities, MBS, and sold them. The idea was to spread risk. The result was the opposite. Risk soaked the entire financial system. From 2007, housing delinquencies surged. In September 2008, Lehman Brothers failed and AIG was effectively nationalized, and the crisis became impossible to ignore. Banks stopped trusting each other. That's a credit freeze. Money stops moving. The economy freezes like a body with no blood circulating. The contrast with 1987 is sharp. In 1987, machines sold while the economy was healthy. In 2008, the economy itself was losing credit, its lifeblood. Look at the SPY daily chart around March 2020. about a 34% drop, same order of magnitude as 1987. But the recovery was the opposite. 1987 took about a year and a half. 2020 hit new highs in just 8 months. The reason is clear. The Fed and the U.S. government immediately signaled unlimited support. Their red was simple. The economy isn't broken. Fear froze it. Flood it with liquidity, and the fear will fade. Execution was fast and bold. The Fed cut rates to zero and pledged to buy treasuries and mortgage securities without a hard ceiling. Congress also unlocked roughly $2 trillion in emergency relief. The outcome surprised many. Exactly 8 months after the March low, SPY printed a new high, and tech and online names like Amazon, Netflix, and Tesla went on to post gains of roughly 300% to 1,000%. That's the historical gap with 2008. In 2008, the Fed and government started serious support late. In 2020, they moved fast and hard. The biggest lesson: economic data matter, but the Fed's decisions and how quickly they act often set the timing and strength of the recovery. Now, with the SPY weekly chart open, let's learn 5 signals that help spot a crisis early, things that show up concretely on charts and in the news. Signal 1. The P/E ratio. Check SPY's current P/E on the chart or in financial news and see how far it sits from the multi-year average. Historically, late bubble readings, like around 20x in 1929 or 50x in the 2000 tech bubble, run far above a typical 12-20x range. Signal 2. Moving averages. On this SPY weekly chart, if the 50-, 100-, and 200-day averages all slope up and to the right, that's bullish. If even one rolls over, it's a bearish warning. Check it yourself. Signal 3. Volume. Watch the volume bars under SPY. A late rally volume spike that then fades can foreshadow a correction. Persistently high volume on the way down is a fear-selling signal.
시그널 4. 더 빅스 발러틸러티 인덱스.
Officially, above 30 reads as fear. Below 15 often reads as complacency. Cross-check SPY's daily swings. If XE and price action disagree, stay alert. Signal 5. Policy signals. Fed meeting headlines, rate hike or cut announcements, and emergency government support often set recovery timing. Charts alone can miss this. Keep policy news on your checklist too. Last look at the SPY monthly.
인더 2008 크라이시스. A 100% 스톡 포트폴리오 로스트 어바웃 57%. 버던 일러스트레이티브 믹스 오브 40% 스톡스, 30% 반즈즈, 10% 골드, 옌드 20% 캐시 소 로시즈 클로서 투 20% 오버 더 세임 스트레치 대츠 더버 서퍼케이션 넷 워크.
Keeping cash and bonds together gives 2 benefits. First, it cushions the depth of a brutal drawdown. Second, when cheap opportunities appear like 2009, you still have cash to put to work. One caution: these weights are only a historical illustration from the 2008 environment. Rates, asset correlations, and inflation then were different from today, so don't assume the same mix will deliver the same result now or in the future. Build your own portfolio around your goals, time horizon, and risk tolerance, and talk with a qualified professional. Remember, this lesson is for education only. It is not investment advice and not a promise of returns. History teaches lessons from the past. It does not guarantee the future. Every investment decision is yours, and we recommend professional advice. In the next lesson, we go deeper.